All right, let's talk a little C-suite conversation here. We can do that with the hotel business. Mark Hoplamazian joins us. He's the president and chief executive officer of Hyatt Hotels, joining us via Zoom. Hey, Mark, thanks so much for joining us here. I'm looking at your stock here, 52-week high. For those that don't know, H is the symbol. It's cool to get that one of those single letter symbols there. That's always pretty cool for us Wall Street folks. It's got a market cap of $15.7 billion. Stock's up about 0.3% today. Mark, talk to us about your recent earnings and kind of what was the messaging you needed to get across to your shareholders?
First of all, it's great to be back with you all, and thanks for having me. I think the clear message was really centered around the fact that the transformation of the company to an asset lighter platform has now shown up in the numbers in a very material way. We had the highest free cash flow in the company's history. We also had the mix of our asset light earnings to our total earnings went up to 76%. 5 years ago, that was in the mid 40s.
Hey, Mark, could you describe for us what your asset light strategy is? Is that relying more on franchisees?
Yeah, so it's not really. I wouldn't call it an asset light strategy. I would call it an asset light program where we were selling down. We had two major drivers of our earnings. One was from real estate that we own, hotels, and the other was from management and franchising hotels across the world. We're primarily a management business, not a franchise business, but those are the two businesses. So as we sell down real estate, the proportion that's coming from real estate sourced earnings has been dropping. We've concurrently reinvested in buying new platforms and new brands over the last 5 years, and that has driven up our management and franchising fees at the same time. So the mix has shifted to much more in the management and franchise fee driven business, which is very low capital intensity. And high margin and high free cash flow conversion. So that was probably the key message. The other thing that we did is we simplified our financial presentation because we have a business that's a subscription model membership business called Unlimited Vacation Club. And we sold the majority interest in that business to a third party, which helped us simplify how we report our earnings. And that was very well received by investors.
So Mark, that's you in the C-suite managing all of that. What about the demand side of the business? What kind of pricing power do you have per room, and what's the demand situation like?
Actually, demand, so we think about three different demand drivers. One is leisure, which has been the leader of the recovery through post-COVID period. We think about group business, which is big meetings and conventions and things like that. And we also have business travel, individual business travel. All three are showing signs of great momentum and positive outlook. So starting with leisure, in the first quarter of this year, our pace, meaning our bookings, are up 11% for our all-inclusive resorts in the Caribbean and also up for our resorts in the Americas. But leisure travel has been really, really solid. In China, we had a record year for Lunar New Year. The spending amongst Chinese, both inside of China and to other destinations in Asia, was at an all-time high. So that's leisure. In group, our pace into this year, that is forward bookings, are up 8%. And so we're looking at another solid year of growth in meetings. And I think corporations are increasingly resolved to make sure that they prioritize those meetings. And then on business transient, the U.S. is lagging, but the overall business transient category demand around the world is about 7% below where it was pre-pandemic. So we're getting closer and closer to being at parity. Europe is fully recovered and then some. China is fully recovered and then some. The United States is still lagging. So, we're seeing signs of positive signs of business transient travel increasing. So I would say across all three major categories, we're seeing positive trends into 24.
Mark, could you talk to us about M&A and kind of growth via acquisition? How does that figure into your growth plans? What are you guys messaging to the street about your willingness to engage in M&A? Because I know you had a buyout recently of the Apple Leisure Group. I want to see kind of what your appetite is going forward.
Yeah, so over the past 5 years, we've invested about $3.8 billion in acquisitions. The biggest one being Apple Leisure Group at $2.7 billion. And it's been tremendously beneficial to us because we've been able to expand our customer base in the highest growth and most relevant to us categories, which is leisure, lifestyle, and luxury. And so we've really done this in a very deliberate way to move the company in that direction. In the fourth quarter, I think we had 57% of our total rooms revenue around the world was leisure focused, which is up 20 points from the mid-30s to the mid-50s pre-pandemic till now. So the mix in the company has tremendously shifted. But they've also been very profitable and high value acquisitions. The fees per room that we are earning today are materially higher than they were 5 years ago before we made these acquisitions and evolved the company, even as we have grown our select service brands. So we are expanding in lower price points, but our overall fee growth per room has been growing, which is really, I think, part of the equation of actually driving shareholder value on an accelerated basis. In terms of our outlook, I think there will be more opportunities for M&A in the future, but probably smaller scale.
Mark, Paul and I talked about the story yesterday. For the Journal reported that hotel parking fees are spiking because of the fact that you guys that own hotels have to pay more in rent. Interest rates have increased. Maybe there's a demand issue in certain pockets. You got to increase prices where you can. Talk to me about how expensive it is to run your business. Like, where are costs coming down? Where are costs going up?
Yeah, I think the primary, look, first of all, let's start with the biggest cost category, which is people at our hotels. And in 2021, non-union markets, which is primarily in the South, the Sun Belt, the smile of the United States, I think our wage rates went up by 20% over the course of that year. And that started to mitigate or ameliorate in 2022 and 2023. But we experienced a massively acute situation in terms of supply of labor. That's evened out. We were in the mid-teens level. So that's
evened out in that, because we also talked about, didn't we, Paul, about cleaning services, like not staffing, housekeeping, because they just can't find the workers. So do you feel like you're at the right spot?
I would say that there are pockets where we still have shortages, and I think part of that has to do with the nature of the workforce at this point. So we've got a lot of the byproduct of not having a really advanced immigration policy in the United States and H-2B visa program is that at times, especially over the summer where you have peak demand, we don't have the right type of labor that's willing to take those jobs and be happy to start their careers in those jobs. So I think they go together. A lot of the H-2B people that come in on an H-2B visa, which is a temporary work visa, they come and they leave, or the incidence of immigration that allows us to hire people who are coming into the workforce in the United States for the first time has been under some pressure. Now, having said that, overall, our vacancy rates have gone from mid-teens to mid-single digits, so down 10 points, which is extraordinary, and that's over the last 18 months. So we are having a better time finding labor, but there are definitely pockets of constraints still.
Yep, we hear that from a lot of folks in the service business. Hey, Mark, thanks so much for joining us. Mark Hoplamazian, he's the president and chief executive officer at Hyatt Hotels, joining us from Chicago, Illinois via Zoom. The company stock, H is the ticker, all-time high today. So how about that? They had some pretty solid numbers recovering from the pandemic, like we see a lot of other entertainment and leisure spaces.